S&P 500 futures are oscillating right at the flat line. Nasdaq 100 futures down about 0.112%.
And the number that is dictating everything.
The 10-year Treasury yield, pinned at 4.18%.
It is a market in a state of suspended animation. Complete suspended animation. Volatility is just compressed.
It feels like everyone's holding their breath.
Oh, they are. If you look at the institutional desks this morning, they are absolutely refusing to pick a direction. Everyone is paralyzed ahead of tomorrow's January jobs report.
And there's not much of an overnight catalyst to go on, is there? The macro engine seems to be stalling.
It is. The European Central Bank, they held rates steady overnight.
Right, signaling no pivot until the Fed blinks.
Exactly. And then domestically, we just got the weekly jobless claims. They hit exactly on consensus at 215,000.
Which usually calms the market down. You know, consensus is comfortable, it's safe.
Usually. But right now, comfortable is actually dangerous. It means the labor market is cooling, sure, but it's not cooling nearly fast enough to force the Fed into an early rate cut.
So that Goldilocks trade is getting a little shaky.
It's being stress tested big time. The market wants a reason to rally, and the data just isn't giving it the green light.
Let's look at the pre-market movers then. Because despite the flat indices, there is some violent rotation happening under the surface. NVDA, up 2.1%.
That is the AI premium at work. It's all driven by reports of this massive sovereign AI infrastructure deal in the Middle East.
It's the only thing keeping the Nasdaq afloat.
It really is.
Oh.
Without NVIDIA, that index would probably be down a full % this morning.
It's incredible. The whole market on the shoulders of one stock. Now, on the flip side, look at Disney. It's down 3.4%.
And this is after they beat on top and bottom lines.
Which should trigger a rally.
But the market is punishing the outlook. That weak forecast for linear TV ad spend, it's a killer. The streaming profitability story, which was a darling narrative last quarter, is fading.
People are realizing the legacy business is dying faster than streaming can grow.
It's a math problem. And the market does not like the answer it's getting.
And then there's Palantir, up 4.5%.
That's a Tier 1 defense contract renewal. This is crucial because it proves the government segment has real teeth. It's not just hype.
So, okay, indices look calm, but you're saying the Magnificent Seven aren't trading like a team anymore?
No, they're decoupling. You have NVIDIA doing one thing, Apple and Tesla doing something else entirely. And today's bond auction, that is going to reveal who's secretly exiting the equity trade altogether.
Okay, that brings us to the macro overlay. Let's unpack the yield problem. I said 4.18% on the 10-year, but you're seeing a structural ceiling risk that's higher.
The screen shows 4.18%, but the real technical danger zone, the line in the sand, is 4.27%.
Why that number specifically? Is that just a line on a chart?
That's the structural resistance. It's where the bond vigilantes are sitting. If we break that, you're likely going to see a rapid move toward 4.5%. And you have to look at this with the dollar index, the DXY.
Which is spiking, up 0.30% to 97.91. That's a 2-week high.
It is. And a 98 handle on the DXY matters.
So for the listener, why does that matter for their tech stocks?
Well, it's a double whammy. First, a strong dollar eats global earnings for the Mag 7. All that overseas revenue is worth less when they bring it home. It's an automatic haircut on EPS.
And the second part?
The discount rate. This is Finance 101, but it runs the world. When you have yield pushing 4.30%, you are increasing the discount rate for all those future growth cash flows.
It's just math. Future profits are worth less today.
They're worth a lot less today when you can get a risk-free 4.3% from the government right now.
Which explains why the Nasdaq has been so heavy.
Exactly. But here's where it gets really interesting. There is a hawkish pivot trap that's forming.
A trap? Okay, walk us through it.
Retail traders are trying to buy the dip in AI. Say yesterday's weak ADP jobs report, only plus 22,000 jobs, and their muscle memory kicks in.
Right. Bad news equals Fed cuts. That's been the playbook for 2 years.
It's been the classic playbook, the Fed put. But the market is ignoring that labor data this time. It's focusing on two other things, inflationary tariffs and the Kevin Warsh Fed share nomination.
Kevin Warsh is a known hawk. He's not the type to print money to save the stock market.
Precisely. So if he's the nominee, the assumption is the Fed will tolerate more economic pain to kill inflation for good. The smart money knows this. They aren't buying the dip in tech.
So where are they going? Are they just leaving the market?
No, the smart money isn't leaving the building. They're just moving rooms. They're aggressively rotating into energy and value.
And that leaves tech in a sideways to down grind.
That's the likely result, yes.
Let's follow that money then. Energy is the alpha play right now.
It's the strongest sector on the board. We're seeing capital flee those high multiple AI names and just pour into cash flow heavy cyclicals. It's a textbook rotation.
Supported by that firmer dollar and, I assume, geopolitical tensions.
A firmer USD and, critically, Middle East tensions. It's the perfect storm for energy. If supply chains get disrupted, oil spikes. Energy stocks love it, tech stocks hate it.
Which brings us to our deep dive ticker, Enphase Energy, ENPH. It sits right at that intersection of tech and energy.
And what a move. The stock is up 38% intraday. It's just an explosive move after their earnings beat and a solar demand pivot.
38%. That sounds like more than just earnings. That sounds like a short squeeze.
Oh, it is absolutely a squeeze. Enphase has been one of the most hated stocks of the last year. Hedge funds were shorting it into oblivion.
And now they're getting carried out.
They are. Enphase signaled the inventory glut is over, and that was the spark.
So for a trader looking at this, how do you handle a 38% gap up? You can't chase that, can you?
You never chase a vertical move. You trade the levels. For the bull case, it must hold $52 support and clear $55. If you can do that, the target is $58.
Why $58 specifically?
That is the gap fill from the 2025 sell-off. Gaps are like vacuums in technical analysis. The algos will try to push price right back into it.
And the bear case, if this just runs out of steam?
Failure to hold above $52 puts $48 right back in play. Below that, the squeeze is dead, and you do not want to be the last one holding the bag.
Okay, we also have a different kind of play on the radar. Silicon Laboratories, ticker SLAB.
Right, the strategic acquisition by Texas Instruments. A merger arb play.
So you're not betting on earnings, you're betting on the deal actually closing. What's the trade here?
The bull target is $225. That's the projected premium capture if the regulatory path looks clear.
But regulators have been so aggressive lately.
That's the risk. The bear floor is $195. That's the deal risk floor. If antitrust hurdles pop up, that premium vanishes and the stock drops to $195 instantly.
Got it. Okay, let's zoom back out to the indices. We need to talk institutional levels. S&P 500, the ES.
We're seeing that structural fatigue I mentioned, right in the 6,900 to 7,000 range.
So where is the line in the sand?
6,900. It's a nice round number, but it's also a high volume node. Above it, by the dip stays alive. Below it, you trigger a 2 to 3% correction.
And resistance if we do get a pop?
First, watch 6958. That's the 161% fib extension.
An algo target.
A self-fulfilling prophecy. And above that, of course, you have the psychological high at 7,002.
Okay, now contrast that with the Nasdaq, the NQ. It looks much weaker.
It's in a much more precarious position. It is languishing below its 50-day moving average for the first time in months. That's a huge trend change signal.
And that was triggered by AMD's weak guidance, right?
It was. It started an AI CapEx re-rating. The market is starting to ask, where is the ROI on all this spending?
So what's the level to watch there?
25,000. It absolutely must reclaim that level to neutralize the lower high pattern that's forming.
Which raises the big question, is this just consolidation, a healthy pause, or is it distribution?
And you call it a liquidity trap in your notes. That implies the big boys are selling.
It does. I think we are seeing distribution disguised as consolidation. How can you tell the difference? The chart just looks sideways.
You have to look at the dark pools.
Break that down.
Dark pools are those private exchanges where the whales trade, the big institutions. And right now, we're seeing net selling in large cap software in those dark pools, even while retail is buying on the public exchanges.
So retail is buying the dip on Robinhood, and the institutions are quietly handing them the bags in the private markets.
That's exactly what's happening. The risk here is a fake-out move. We could see a quick pop above 6950 on the S&P. It'll lure in late bulls.
Right before they pull the rug.
They use that retail demand as exit liquidity.
And that rug pull could be triggered tonight. The main event.
Amazon, ticker AMZN.
Consensus revenue is $211.3 billion, a staggering number. But it's not about the top line, is it?
No, it's all about AWS. The stakes could not be higher for their cloud division. Anything less than 20% growth in AWS breaks Nasdaq support, period.
Why is AWS so critical? It's the proxy for AI, isn't it?
It is the proxy for AI adoption. If AWS slows down, it means the AI boom is slowing down. It tells us if all that CapEx from Microsoft and Google is actually turning into real revenue.
Okay, so give the listener the levels to watch for Amazon tonight.
If you're a bull, you need to see a break above $200. That confirms the cloud AI narrative is intact. The target then becomes $200 to $12.
And the bear case.
If CapEx is too high or growth is too slow, we retreat to the 50-day moving average at $188.
So putting it all together, yields at a ceiling, a hawkish pivot trap, dark pool selling, Amazon on deck. What's the final directive before the bell?
It's simple. Sit on your hands until the Amazon print.
The hardest thing for a trader to do.
But saved capital is earned capital. The volatility around Amazon and tomorrow's jobs report is going to be binary. It's a coin flip. You don't trade coin flips.
And if the S&P does lose 6830 amidst all this noise,
Then sentiment shifts from caution to aggressive bearish.
keep it tight.
Trade the levels, not the noise. We'll see you on the other side of the bell.